Good evening. Please come to this wonderful IFRS 13 fair value measurement. Yesterday we have seen the important definitions. Now we'll see the application of the standard. In this standard, the fair value will be measured with reference to the principal market. Okay. If the principal market is not there, then we'll take the most advantageous market. Which is the principal market? The market with highest volume and activity. And which is the most advantageous market? The market from where you will get the highest cash revenue, cash inflow after deducting the transportation cost and the transaction cost. Transportation cost and transaction cost will be deducted from selling price for finding the most advantageous market. But once you are able to identify the most advantageous market, the fair value will be only the selling price minus the transport cost. It will not include the transaction cost. Okay. So the price will be exit price, regardless of whether that price is directly observable or estimated using another valuation technique. So this standard says the price will be exit price. That is the price you will receive when you sell an asset is called exit price, or the price that you will pay to settle a liability. Do not adjust transaction cost. Why? Transaction cost is not an attribute of the asset, but you will adjust the transport cost because transport cost depends on the location of the asset. Location of the asset influences the fair value of the asset. Now see one example on the screen with solution also. Wow. Market A and market B are at different prices. So there is a product which is selling in market A and market B at different prices. Omega enters into transaction in both market. So it is doing transaction in both market and can access the price in those market for the asset at measurement date. So market A and market B price 26 and 25. But if you deliver in market A, the transaction cost is 3 rupees and the transaction cost is 1 rupee here. To deliver the goods to market A, transportation cost is 2 rupees and the transportation cost is 2 rupees here also. In case if they ask you what will be the fair value for market A, the fair value will be price minus transport cost, that is 26 minus 2, 24, 25 minus 2, that is 23, right? But suppose if I ask you which is the most advantageous market, just check which is more advantageous market. 26 minus 3 minus 2. Is it 21? 25 minus 1 minus 2. 22. So which is the most advantageous market here? Market B. After identifying market B, we will take the fair value is 23. Okay, now come to this standard again. So this is the most advantageous market and we'll take 23 rupees as fair value. Next paragraph is application to non-financial asset. Application to non-financial asset. What do you mean by non-financial asset? For example, land, building. This we will call non-financial asset. Okay. Financial asset is an asset which is a right to receive cash or other assets, other financial asset. Okay. Or to exchange one financial asset against another financial asset under conditions which are potentially favorable. That you have learnt in IFRS 9 some days back, right? In case of non-financial asset like land or building, the fair value measurement of non-financial asset takes into account the highest and the best use. So here the market participant will think what is the highest and the best use of that non-financial asset. So fair value will depend on the highest and the best use. An asset can have more than one use. An asset can have more than one use. A land can be used for constructing flats for residential purpose. The land can be used for construction of commercial building also. The land can be used for factory building also. So what will be the fair value? It depends on what is the highest and the best use. Okay. So the highest and the best use of a non-financial asset takes into account the use of the asset that is physically possible. So first is, if you are considering highest and best use, then consider physical possible, that is the location or the size of property, where it is located. Okay, what is the size of the property? Second, it depends on legal permission, legally permissible. That means there is a land and you want to construct, let's say, factory building. Just check, is it factory building allowed in that location? Like for example, there can be zoning regulations. What is that? That means some land cannot be used for industrial purpose. Some land cannot be used for commercial purpose. So then in that case, you will not consider that. And then one has to also see financially feasible. Example, required return on investment. Understood? That means while considering highest and best use, see the physical possibility, legal possibility, financial feasibility, and then consider the fair value. When measuring the fair value of a non-financial asset used in combination with other asset. Now what is this? Suppose you have to value land and building. So you have to value both of them together first, and then from that you can remove the value of the building, for example, so that you can arrive at the value of land. So sometime in one asset you have 2-3 assets combined. Say this classroom itself. How many assets are there? Count. 10 assets are there. Yes, 10 different types of assets are there. So when measuring the fair value of a non-financial asset used in combination with other asset, this classroom, or in combination with other assets and liabilities, like for example a cash generating unit, the effect of valuation might be the same whether used on standalone basis or as a group. So the meaning of first line is that the value of the non-financial asset, each item added together is equal to total of the group. That is one possibility. Then incorporated through adjustment to the standalone value of the asset. Third is incorporated through the assumptions relating to market participants. So when you are valuing non-financial asset which are used in combination with other asset, these are the things you have to take care and incorporated into valuation technique used to measure fair value of the asset. Next paragraph. Application to liabilities and an entity's own equity instrument. So now we are doing fair valuation of liability and fair value of an entity's own equity instrument. Fair value of liability and fair value of entity's own equity instrument. A fair value measurement of a financial or a non-financial liability or an entity's own equity instrument assumes it is transferred to a market participant at the measurement date. Underline, and important underline, without settlement, extinguishment or cancellation at the measurement date. While valuing liability, you will assume transfer. While valuing liability, okay, financial or non-financial, or entity's own equity instrument, the valuation would assume transfer. Valuation will not assume settlement, extinguishment, or cancellation. This standard says when you are valuing liability or own equity instrument, we have to value on the assumptions that they will be transferred from one party to other. They will not be cancelled or settled. While calculating the value of liability, one should also take into account non-performance risk. What do you mean by non-performance risk? The risk that the entity will not fulfill an obligation, including an entity's own credit risk. Like for example, in order to value a liability, we will use 10% discount rate normally. But if there is a risk that this entity will not pay, we will add 0.5% more as a discount rate. So the discounting will be done at 10.5% instead of 10%. Okay, so that is the meaning of incorporating the risk of non-performance, including an entity's own credit risk, and assuming the same non-performance risk before and after the transfer of liability. Now I'm going to take one example so that this liability instrument will be measured at fair value. Question number 1. Is it printed there? Z Limited has a non-financial liability. Our topic is right now valuation of liability and entity's own equity instrument. So we have discussed following points. Valuation of liability assumes transfer, not settlement or cancellation. Valuation of liability takes into account any non-performance risk, including entity's own credit risk. Keeping those two things in mind, solve this example. Z Limited has a non-financial liability on account of advance from customer of rupees 100 lakh. While measuring the fair value of this liability, Z Limited shall consider the effect of the failure of timely delivery of the goods and service. Suppose there exists a legal or constructive obligation of paying a compensation for the delay. How should Z Limited apply non-performance risk for the purpose of fair value measurement? Assume that compensation of delayed delivery is 1 lakh and the probability of which is 50%. Now, dear student, solve. What will be the fair value of this liability? What is the liability in the books? 100 lakh. You have taken an advance from customer. You have taken an advance from customer. And what is your contract with the customer saying that in case if you fail to deliver, then in that case, you will have to pay a compensation for delayed delivery. You have to pay a compensation for delayed delivery, 1 lakh. What is the chance of paying compensation? 50%. So tell me what is the answer? 100 lakh plus 1 lakh or 1 lakh into 50%? 50% of 1 lakh. So your answer would be, while calculating the fair value of the liability, we shall take into account the probability of default and find out the weighted average additional payment to be made for failure to maintain the delivery schedule. Okay. The fair value of the liability is 100.5 lakh. In bracket, the calculation is 100 lakh plus 50% of rupees 1 lakh. One more paragraph we'll discuss just below that question number 1. Sometimes instead of valuing the asset separately and the liability separately, you can do the fair valuation on net basis. You can do the fair valuation on net basis, and that is an option, not a mandatory requirement. An optional exception applies for certain financial asset and financial liabilities with offsetting position in the market risk or counterparty risk provided certain conditions are met. Like for example, we have a foreign currency asset, and to protect this risk we have created a foreign currency liability. So I have a receivable in foreign currency and I have a foreign currency liability also. Now my foreign exchange risk is managed like this. If the rate of exchange goes up, value of the asset will go up. There will be an exchange gain here, but there will be loss, vice versa. If exchange rate falls down, there may be a loss here and there will be gain on the foreign exchange liability. So in this case, what we can do, we can calculate the fair value on a net basis. An optional exception applies for certain financial asset and financial liabilities with offsetting position in the market risk. This is the market risk, exchange rate. If exchange rate goes up or down, the rate value of the asset will go up or down, or counterparty credit risk provided certain conditions are met. So this is that last paragraph. So what are the things we have covered so far? What is fair value? What is principal market, most advantageous market? How to calculate fair value for non-financial asset, highest and best use? How to calculate fair value of liability? Is it right? Taking into account the non-performance risk and credit risk. Now we will come to fair value at initial recognition. Today I purchased this mic. Okay, example. What is the fair value? Fair value is the transaction price. Fair value is the transaction price. So normally, but not necessarily. Normally, but not necessarily, the transaction price is the fair value. But transaction price is not always the fair value. Okay. People don't even apply their mind. Whatever is the transaction price, they record the asset, liability, everything at that amount. Yes or no? But the standard says transaction price and fair value are not necessarily the same thing. Why? Suppose I go to a shopkeeper and I ask him, will you sell this mic to me? He says, yes. What is the price? 5,000. I said, no, I will pay you 4,000 only. And he is in the urgent need of money. He is into distress mode. He will sell to me for 4,000 rupees. So in that case, the transaction price is not equal to fair value. Or suppose I go to a relative, okay, close relative as per IS 24, and then I ask him, I want to purchase this mic. He says, oh, you, after many days, I'll give you for 50% discount. Is that the fair value? No. So therefore, one should be careful while choosing the transaction prices fair value. In some cases, it may not be equal to fair value. So such transaction price should be exit price rather than entry price. Point number 1 is transaction price should be exit price rather than entry price. What is exit price? Exit price means the price that you will receive when you sell an asset or pay when you transfer a liability. And what is an entry price? Entry price is price you pay when you acquire an asset, okay, or a liability is assumed. So which price we have to take discussed earlier also, today also, second time, exit price. Is transaction price always equal to fair value? No. Sometimes the transaction may be with related party, so it may not be at fair value. Transaction may be with a seller who is under financial difficulty. Like the example I said, I went and I asked for a mic for 4,000, which otherwise in the market was selling at 5,000. So he had the need for money, he sold it. And transactions entered into different markets. If you buy a water bottle from airport, how much do they charge? Airport water bottle, 100 rupees. If you buy in the market, normal market, they charge you 20 rupees. So can 100 rupees price paid, which is a transaction price, in an airport, a fair value? No, not necessary. Is it right? Now, before you go into sleep mode, we will solve one example. Question number 2. X Limited granted loan to Y Limited for 5 years at 8.5%, which is a treasury bond yield of equivalent maturity. But the incremental borrowing rate is 12%. In this case, the loan is granted to Y at below market rate of interest. The loan amount is 100 million. So transaction price is 100 million. But is it really the fair value? No. Why? Because they are charging an interest rate of 8.5%, whereas the market rate or incremental borrowing rate is 12%. So what you will do? You will compute the fair value by using the 12% discount rate. Okay? And then you will be able to arrive at fair value. So find out what is the fair value of this loan today. How much is the coupon rate? 8.5. You make it 8. I don't know whether the answer is correct or question is correct. Answer is correct. In answer they have written 8. Which is right? Checked. 1 divided by 1.12. Press equal to 5 times. Then multiply by or then press GT function. They're not answering. Is it right? Okay. So I'll explain how this calculation is done. There are some errors which you will rectify. If the coupon rate is 8% on a 100 million loan, 8 will be paid. 8 upon 1.12 to the power 1 is the present value of 8. Present value of 8 received in year 2. Present value of 8 received in year 3, year 4, year 5. Now this is only coupon. One more thing they should add here. Principal amount 100. Principal amount 100. You can make it 108, the last one, 108. And now tell me the answer. 85.58. So what you do, dear student, just make a small correction here, make it 8%. Interest rate here 8%. Done. And you make one more correction here, you make it last figure 108. 108. But transaction price was 100. Transaction price was 100 and fair value is 85.58. So what about the difference of 14.42? If nothing is given in the question, then you treat it as a fair value loss and will be recognized in profit and loss account. This question we have done actually in IFRS 9. IFRS 9 financial instrument. Similar problem I had done there.
But here I am using 12%, which is the market. Should I discuss this in L1 input category?
Yes. Market rate of interest for similar instrument is 12%. So this will come as a level 1 input. Because there is an observable market data for the similar loan. Now we will repeat one paragraph quickly. How many valuation techniques they have mentioned in the standard? 3. Which 3? Market approach, cost approach, income approach. Market approach means either we have the same asset quoted in the market, or we have identical or comparable asset or liability or group of asset for which the quoted price is available. So at least we have some basis from the market which can be used for calculating the fair value. See one example. There is an unlisted company and it wants to get itself valued using some price multiple approach. So what we will do, we'll find out a similar company. We'll find out a similar company which is listed on the stock exchange. And can we find out the PE ratio of a similar listed company? Yes. Take P ratio of a similar listed company multiplied by EPS, you'll get the value of the share. So this is like using market data to find out the fair value. Very popular method used by equity valuers, P multiple approach. So P ratio will be called observable input because there is a market price, there is EPS, they are available from the quoted market. So the selection of appropriate multiple within a range requires judgment considering qualitative and quantitative factors specific to the measurement. In valuation, many multiples are used. Which are the other multiples you have learned? One is P multiple, book value multiple. One is called book value multiple. Formula for book value multiple: market price upon book value per share. Market price upon book value per share. Then there is one more, sales multiple. Sales multiple also. Is it right? Market price per share upon sales per share. Then enterprise value or market capitalization upon earning before interest, tax, depreciation and amortization. So these are called observable input. According to the nature of the business, okay, or situation, we can use one or more multiple approach. In case of unlisted company equity that we have discussed, what about cost? Cost model is not used much, but it says cost means current replacement cost. How much will it cost to replace the service capacity of the asset today? That is, what is its current replacement cost? Generally used for, say, non-current asset like building, etc. Okay. And the next is income approach. This is what is taught in financial management literature. You estimate the future income, future cash flow, future expense, and convert into present value by using an appropriate discount rate. Okay. So this is called income approach, which normally taught in your financial management subject: valuation of bond, valuation of share, valuation of business, reflecting current market expectation about those future amounts. What are the techniques we use here? Present value technique, option pricing model, multiple period excess earning method. All this you will learn in your financial management subject. Not a topic for today's discussion, right? For example, value of equity, one or two examples I have written, which you do in your financial management subject. Valuation of equity, you estimate the future earning or future dividend and then you discount it using appropriate cost of equity. Second example, valuation of bond, estimate the future interest and principal repayment and discount it. But in case of some situations, valuation may be based on more than one method also. Like for example, in case of valuation of business, a business has three segments. So maybe one segment will be valued using discounted cash flow method. One may be valued using P multiple. One may be valued using book value multiple. And then you add them. So that is called multiple approach. So normally in case of diversified businesses, this multiple valuation methods can be used. Now we'll come to fair valuation hierarchy. Sir, what is fair valuation hierarchy? It means which input we will give more priority and which input we will give least priority. So there are three levels of input: level 1, level 2, level 3. Level 1 will be given highest priority because they are the quoted price in an active market, and level 2 will be given next priority, and the least priority will be given to level 3 because level 3 deals with unobservable inputs. Okay, so now there is a comparison chart drawn between level 1, level 2 and level 3 inputs. Level 1, this can be a theory question also. What are the three levels of input for fair value determination? And then you have to write their meaning, some examples if you can. So first is quoted price in an active market. Quoted market price in an active market provides the most reliable evidence of fair value, and this is used without adjustment except any adjustment provided in the standard. So I have to find the price of Infosys share. What will I do? Will I appoint a valuer or will I go to the stock exchange? Stock exchange. Because in stock exchange there are lakhs of people buying and selling. Okay, they are not forced to buy and sell. They are competent to buy and sell. Prices are available to everybody, and there is a large volume of transactions. There is a continuous buying and selling activity. So I can simply say this is the price or fair value of share. And then what is level 2? Level 2 is also based on observable input, but they are not available in the active market or not available for the same asset or liability. So sometimes they may be also traded in a market but not in an active market, or we may not get the direct answer for those asset or liability, but there may be similar asset whose value can be used as a basis. So input other than quoted price included in level 1 that are observable for asset or liability. If you can find level 1, nothing like that. If the asset or liability has a specified or contractual term, a level 2 input must be observable for substantially the full term of the asset or liability. So if you are having a 10-year bond to be fair valued, then if you are comparing with another bond which has an 8-year fair value, then it may not be appropriate. So what they are saying, the observable input that you are using should have the same term like the asset or liability to be valued, and level 3 are unobservable input. So you can just write these are those input for which fair value is not available from the market. Okay, and here the management has to apply their judgment. Next is level 1 inputs are available for many financial assets and financial liabilities and commodities. Like for example, shares which are traded on the stock exchange, bonds which are traded on the stock exchange, commodities which are traded. Okay, these assets and liabilities may be traded in multiple exchanges. So examples are shares, bonds, commodities. And what are the example of level 2? Quoted price for similar assets or liabilities in an active market, and quoted price for identical or similar asset or liability in a market but that are not very active. Similar asset in an active market or similar asset in a less active market, or you can say same asset in a less active market also. Now what example we can give here? No example, because they are not observable. Only you can say the market management has to make the estimate. For example, their projected income statement or projected figures. The objective of fair value measurement remains the same. So what they have said here, without giving example, while applying level 3 input, keep the objective same. What is my objective? To calculate the fair value using exit price from the point of view of a market participant. An entity shall develop unobservable input using the best information available in the circumstances, which might include entities' own data, like some projected figures. Now your boss has said go and find out level 1 input. From where will you find it? Level 1 input will be collected from the principal market. Okay. You have to find out in which market you have highest volume. Infosys may be traded in Nasdaq also, National Stock Exchange also. Where will you go to find out the fair value? The principal market, that is National Stock Exchange, or most advantageous market. It also assesses whether the entity has access to that market. If you don't have access to the market, then will not consider. Okay. You may not trade in that market, but you may have access to that market. Then we will consider that principal market. And level 2, where will you go to find out this? Input other than quoted price that are observable for asset or liability, for example, interest rate. And yield curve observable at commonly quoted intervals. So you can take interest rate yield curve. Sir, what is that? All this is taught in your financial management. If you have to value bond issued by Tata Motors Limited, but suppose it is not traded, government bond yield is available. Government bond yield is available. So I will take the government bond yield. But then the two are not same. Two are not same. There is a high degree of risk in Tata Motors bond. So what I'll do? Add risk. Is it right? Say 1% risk for that. So if the government bond yield is 10%, I will use 11% discount rate for valuing the bond of Tata Motors Limited, or for example, implied volatilities, credit spreads, or market corroborated inputs. So these are the other data that you will use for making adjustment in similar assets. And the third one, what can we say? Because we don't have any observable input here. For the purpose of developing unobservable input, although an entity may begin with its own input, it shall adjust those data from the perspective of the market participant. Now, what about the adjustments to be made? Prima facie, no adjustment is made in level 1 input, except those which are allowed by the standard. Level 2 adjustment to level 2 input is carried out. And third is risk adjustment may be necessary in the fair value measurement when there is a significant measurement uncertainty. Right. So we have already covered level 1, level 2 and level 3 inputs. Do you want to repeat it again or can we go ahead? Same thing is written now. Same thing. Theory question, remember, for level 1, level 2, level 3. Now I am going to give you a question which you are going to solve on your own. Are you ready to take this challenge? Say yes. Question number 3. Answer is not there. Oh. So use your skills and give me the final answer. 1 minute will be allowed to you. Is it over? First, we'll find out what is the yield on this 2-year asset. A contractual right to receive 1215 2-year, and its current market price is 1080. Can I find out the rate of return this asset is generating? Now there is no comparable asset which matures in 1 year. There is no comparable asset which matures in 1 year, but the zero coupon yield on government security of 2-year rate is 40 basis point higher than 1-year rate, which means 1-year rate is less than 2-year rate by 40 basis point. Sir, what is 40 basis point? 0.4%. So to value a 1-year instrument, what I'll do, I'll first find out the rate applicable for a 2-year, less 0.4%, use that as a discount rate for valuing this 1-year instrument. Is it right? So now write down, dear student, write down little fast, the implied annual rate of return, the implied annual market rate of return for asset B is, the implied annual rate of return. So calculate it, you will get it like this, 1250 divided by 1020. It is a 2-year problem, so raised to the power 1 by 2. What if it was a 3-year problem? 1 by 3. Is the answer 7.58%? You can cross check. 1080 plus 7.58% plus 7.58% should become 1250. If it is a 3-year problem, take 1 by 3. 4-year problem, take 1 by 4. Okay. This formula is formula of future value calculation. Now for 2-year instrument, the implied rate is 7.58%. But the problem says a 1-year instrument is 0.40 basis point lower than a 2-year instrument. So what I'll do, I'll make an adjustment in the discount rate for a 1-year instrument, that is asset A. So write down, the discount rate for asset A shall be 7.58% minus 0.40, 40 basis point means 0.40%, is equal to 7.18%. Therefore, fair value of asset A is equal to, now take 1000 rupees, and divide by 1.0718, that is the factor for 1 year. Are you getting 933? So honestly tell me who got it right. Got it right? You? Okay, no problem. Some students got it right. Now dear student, try your luck for question number 2. Not 2, 4, sorry. This is how you are going to make adjustment to observable data. Is it right? Asset A is a contractual right to receive 1000 after 1 year. Have you solved this? Asset B is a contractual right to receive 1200 in 1 year and has a market price of 1120. So that means there is a similar asset whose market price is 1120 and contractual right is 1200. Using the yield of this instrument, you apply to asset A and get the fair value of asset A. So what will be the fair value of asset A using discount rate adjustment technique? So first you tell me how much rate of return this asset B is generating. 1120 becomes 1200 after 1 year. 7.14. Sure. Let me ask computer. Yes. So 7.14. This is your implied annual rate of return for asset B. The implied annual rate of return for asset B is 7.14%. And then this time I will say the same rate is applied to asset A. The same rate is applied to asset A. The same rate is applied to asset A because there is no other information. So assuming that both are similar assets, therefore fair value of asset A will be equal to, now what is the cash flow asset A will generate after 1 year? 1000 divided by 1.0714 is equal to, come on, Angie, 933.36. So this is the use of the market data of similar asset to find the fair value of the given asset. Okay. You want to try one more? Try your luck. Let us see who will give me answer of question number 5. First you try. I will not explain because when I explain you get all the hints. First you will try. Are you trying? This is a good example of how you use other companies' data or a recent transaction. Okay, start. Sun Limited acquired 5% equity share of Moon Limited, an unlisted company, for rupees 100 lakh. It was assessing the fair value at subsequent measurement, that is at the end of the reporting period. It observed a recent transaction of the company share in which Star Limited acquired 20% of the equity share of Moon Limited for rupees 600 lakhs. Okay. This is based on an enterprise value oblique means upon, not oblique, upon EBITDA earning before interest, tax, depreciation and amortization of 8. So how much value they are willing to pay for this share? 8 times of earning before interest and tax and depreciation and amortization. So this share is commanding 8 times of EBITDA. As on the reporting date, EBITDA is 400 lakh. So can I say the value of this company based on the recent transaction would be 8 into 400, 3200 lakh. And our share is only 5% in that. So into 5%, 1000, 1600, 160, 160. 5% is 160. But you are a non-controlling interest. So for non-controlling interest, the market will discount your value because then you are just a passive investor. You really can't make much impact on the company. So therefore, you have to give the effect of this line also. The Sun Limited assess that the non-controlling discount is 10%. Hence, your answer will be further reduced by 10%. How should Sun Limited measure the fair value as on the reporting date? So write down first heading, calculation of fair value. Calculation of fair value, right hand side, rupees in lakhs, point number A. Fair value of 5% holding. Fair value of 5% holding. Based on EV. What is EV? Enterprise value. Enterprise value means value of the entire company, but there is no debt capital also, so no adjustment is required in that also. Upon EBITDA multiple. So calculation is printed inside the bracket. EBITDA 400 into 8 times 3200. Again in one bracket 3200 into 5%. That is 160. And less discount for, you can write non-significant influence or you can write for non-controlling discount 10%. The percentage stake in a company also affects your value. Do you know that? If you are holding more than 50% share, you are controlling, so there is a premium value for that. But if you are holding few percentage only, 1, 2, 3, 4, 5%, then you get less premium. So if the other party who has acquired 20% share, which gives him significant influence, he must be paying some premium for that compared to your value, which has no significant influence. Is it right? So the answer is 144. Written, write 144, fair value of 5% stake. Now try one more question. Try your luck. Question number 6. Question number 6. X Limited acquired 5% equity share of Y Limited, an unlisted company, for rupees 100 lakh. It was assessing the fair value at subsequent measurement, that is at the end of the reporting period. It observed a recent transaction of a listed company, L Limited. Now here we are comparing with another company, L Limited. So it is based on level 2 input. Okay. Shares in which Z Limited acquired 60% of the equity share of L Limited at rupees 500 as against the pre-announcement price of rupees 430. Now what is 60%? Is it a controlling stake? Yes. Now pre-announcement price was 430, but finally they paid 500 rupees to get the control. So in this example, what is the control premium on 500 rupees? If I take 500 rupees as a base, how much is the control premium you are paying? 14%. 14%. This results in an EV EBITDA multiple of the company peers of Y Limited of 8%. So next is, as on the reporting date, earning before interest, tax, depreciation of Y Limited is 4 crore. So we have to value our 5% equity share of Y Limited. So now it will be 8 into 4. How much is the total enterprise value? Haji? 32 crore. Assume that there is a long-term loan of rupees 5 crore. How should X Limited measure the fair value on the reporting date? So this time I'll prepare 2 working notes. First working note, I'll prepare non-controlling discount. Previous problem and this question are similar. 2 changes they have done. 1, non-controlling discount percentage is not given. So from a similar transaction in the market, we'll find out how much is the non-controlling discount in the market. So the answer is 14%. So right hand side, write down INR, that is Indian rupees. Amount paid per share by Z Limited for getting control. Amount paid by Z Limited per share for getting the control. 500. Point B, pre-announcement price 430. Non-controlling discount. Non-controlling discount A minus B 7070. Point number D, non-controlling discount percentage. Non-controlling discount percentage. Come on, 14%. And one more adjustment we have to do in the next working note. Long-term loan of 5 crore rupees is given to you. So now write down step 2. Calculation of fair value. Calculation of fair value of 5% equity share of Y Limited. Calculation of fair value of 5% equity shares of Y Limited. Right hand side rupees in crores. Point A. What is point A? Enterprise value of Y Limited. Enterprise value of Y Limited 4 crore rupees into 8. Is it 32 crore? Then point B, write down less long-term loan. Less long-term loan. Less long-term loan 5. Therefore equity value. Therefore equity value 27. Equity value 27. Point number D, write down 5% value, fair value of 5% holding. Fair value of 5% holding. You continue in your notebook. A1, A, B, C, D. Fair value 5% holding based on EV EBITDA multiple is 5% of 27, 1.350. But one more adjustment you will have to do. You will have to reduce the value because you are a non-controlling interest. Non-controlling interest share has lower value compared to the one who has controlling stake. So 0.189. Therefore, the fair value of 5% equity share is 1.161. Is right? 1.161. So this is how, these are the examples how we use the level 2 input for getting the fair value of a given asset or liability. Level 3 inputs we have discussed are unobservable inputs for which market values are not available. So here the management will have to apply their own judgment. They have to develop their own method of calculating the fair value, also keeping in mind the market participant assumption that is reasonably available. Example, for cash generating unit, see I have written the example or not? Yes, for cash generating unit, financial forecast which include cash flow developed using entities own data. So to value the CGU, and suppose there is no level 1 level 2 input, what you will do, you will use the cash flow forecast by the management, okay, discount it, and that will give you the value. So these are level 1, level 2, level 3 inputs. Now dear students, come to question number 7. This chapter is more or less over. 2 examples we will discuss and then disclosures. Small chapter. Silicon Limited is a manufacturer of home lighting solutions. Silicon is reviewing the fair valuation of certain assets and liabilities in the light of the introduction of IFRS 13. Okay. It carries an asset that is traded in different markets and is uncertain as to which valuation to use. The asset has to be valued at fair value. Silicon Limited currently only buys and sells the asset in the market C. The data relating to the assets are set out below. There are 3 markets A, B, C. Annual volume of market, price, transport cost, transaction cost. Discuss how Silicon Limited would value the above asset by applying IFRS 3. Which is the principal market? Principal market is the market with highest volume. So if market A is principal market A is accessible, then take market A. Otherwise take most advantageous market. Then in that case, first we have to find out which is the most advantageous market, and then the one which gives higher cash inflow is the most advantageous market. After identifying the most advantageous market, the fair value will be only equal to price minus transportation cost. Okay. So write down. First we'll do the calculation. Annual volume of market. Write down in your book in reasonably good handwriting. Annual volume of market. First 3 lines are already printed. Then potential fair value. Potential fair value is 94, 90 and 98 after deducting transport cost. So while preparing the answer, you prepare in this format. You don't have to make a separate working note. This will give you immediately which is the most advantageous market also and what is the fair value also. Market A is a market with highest volume. So if I go by market A, then the answer will be 94. If I go by the most advantageous market, then the answer will be market C is the most advantageous market because its last line net amount receivable is high, and the fair value for valuation purpose will be 98. Have you written this calculation first? Then I have to dictate a small note. You have enough space to write. Why are you writing on bench? You have enough space to write. I hope you have written up to this. Now write down one small comment. In case of Silicon Limited, the principal market is considered, the principal market is market A, right? Principal market is market A. The principal market is market A as it has the highest volume and level of activity in this market. As it has the highest volume and level of activity in this market. The most advantageous market is market C. The most advantageous market is the market C because it returns the best profit per unit. Because it returns the best profit per unit or best cash flow per unit. Then point number B write down, or second line write down, if the information about the markets is reasonably available, if the information about the markets is reasonably available, then Silicon Limited should base its fair value. Silicon Limited should base its fair value on prices in market A. Should base its fair value on prices in market A due to its being the principal market. Due to it being the principal market, comma, assuming that Silicon Limited can access the market. Assuming that Silicon Limited can access the market. Point number C. This pricing is taken from this market. This pricing is taken from this market even though the entity does not currently transact in the market. Does not currently transact in the market and is not the most advantageous. The fair value would be $94. The fair value would be $94. Use small font. As transport cost would be taken into account, but not the transaction cost. As transport cost would be taken into account, but not the transaction cost. Okay. Now, next paragraph. If Silicon Limited cannot access the market A or market B, if Silicon Limited cannot access market A or market B, or reliable information about the markets is not available, or reliable information about the markets is not available, Silicon would use the data from the market C and the fair value would be $98, and the fair value would be $98. And write one comment, note, the principal market is not always the market in which the entity transacts. The principal market is not always the market in which the entity transacts. So this way one has to draft the answer. Okay. So everything you mentioned based on your assumptions, if A is principal market, then answer is 94. If A is principal market but you can't access it, then C we will take. Now you try one more question. An asset is sold in two different active markets at different prices. Win Limited enters into transaction in both markets and can access the price in those markets for the asset at the measurement date. In market A, the price that would be received is rupees 260, transaction cost is 30, transport cost 20. Thus the net amount is 210. In market B, the price received is 250, transaction cost is 10, transport cost 20. Net amount 220. Is it a question or an answer? So which has a higher cash inflow? Market B. What should be the fair value of the asset if market A is the principal market? And what would be the fair value if none of the market is principal market? So if market A is principal market, then your answer would be fair value. Come on. 240. Why? 260 minus transport cost 20. 240. And if suppose none of the two market is principal market, first identify most advantageous market. Which is most advantageous market? B. Then you find out the fair value in market B. 250 minus 20. Is it 230? Is the answer written in the same way like you have described? Yes. So this way you can write the answer. Will you do it? Homework. Reading the answer is homework. Now the last part, disclosures. So since it is a fair value measurement standard, there is a long list of disclosures. Disclosures are based on whether the fair value measurements are recurring or non-recurring in nature. Recurring means you have to do the fair valuation periodically. Okay. And non-recurring means only on a specific occasion you have to do the fair valuation. So recurring fair value measurements are those instances where other IFRS permits or requires the asset or liability to be measured at fair value as at reporting date. Like for example, IFRS 9 only. On every reporting date, instrument measured at fair value through P&L account, fair value through other comprehensive income. You have to do the valuation. And then non-recurring fair value only in particular circumstances. Like for example, you can say revaluation model. Only when you do the revaluation, then you do this fair valuation. Revaluation is not done every year. It can be done once in 2 years, once in 3 years also. Next disclosure, the fair value measurement as at the end of the reporting period for recurring and non-recurring fair value measurements. What is the disclosure requirement for non-recurring fair value measurement? The reasons for fair value measurement at the reporting date, the level of fair value hierarchy within which the fair value measurement are categorized in their entirety, the amount of any transfer between level 1 and level 2 of the fair value hierarchy, the reasons for those transfer, and the entity's policy for determining when transfer between levels are deemed to have occurred. So, in case earlier you have valued using level 1, now level 2, make disclosures. Which level you have used? If there is a movement shifting from level 1 to level 2, that you have to disclose. And in case of level 2 and level 3, you have to describe the valuation technique. Okay, like you have done some problems today where you have used present value technique, you have used multiple techniques, and the inputs used in the fair value measurement for recurring and non-recurring fair value measurement categorized within level 2 and level 3. If there is any change in valuation technique, entity should disclose the change, reasons for making the change. And for fair value measurement within level 3, what is level 3? Unobservable input. Because here a lot of judgment is involved, assumptions are involved, more disclosures, quantitative information about significant unobservable input used in the fair value measurement, a reconciliation between opening and closing balance disclosing total gain or loss for the period recognized in P&L account, total gain or loss for the period recognized in OCI, purchase, sale, issue and settlements, amount of any transfer into and out of level 3, amount of unrealized gain or losses included in P&L account, and description of valuation process used by the entity. So all this disclosure you have to give in case of level 3 type of input. Why? Because they are more subjective. Last disclosure, if the highest and the best use of non-financial asset, highest and best use means the way a non-financial asset can be used, and if it differs from its current use. Land can be used for constructing a commercial building, but present use is different. An entity shall disclose that fact and why the non-financial asset is being used in the manner that differs from its highest and best use. What is the difference between IFRS 13 and Ind AS 13? In your book I have written, Ind AS 113 and IFRS 13. Is there any difference? No major difference. The two standards are almost copy-paste version of each other. Paragraph 7b of IFRS 13 refers to IAS 26. That is accounting and reporting by retirement benefit plan, which is not relevant for Indian companies. Because in India, IAS 26 or its counterpart is not applicable. This standard is not there in list of Ind AS. Right? This standard is over.